Hey ShopRates Nation, tired of battling banks for a mortgage? What if I told you there are ways to buy a house without getting a brand new loan? Today we're diving into two often confused but super powerful alternative financing methods: assumable loans versus seller carrybacks, also known as wraps. Let's hit the clock. First up, assumable loans. Imagine stepping into someone else's mortgage. Sounds wild, right? But it's totally legit. Mostly with government-backed loans like FHA, VA, and USDA loans. The magic here? These loans are designed to be assumed, meaning they do not have that pesky due-on-sale clause that makes most conventional loans untransferable. This means you, the buyer, can essentially take over the seller's existing mortgage, often keeping their lower interest rate. The catch? You still need to qualify with the lender, but the bar is usually a bit lower than for a brand new loan. Think of it as a pre-approved shortcut. Now let's switch gears to something a bit more intricate: seller carrybacks, often called wraparound mortgages or wraps. This is where the seller becomes your bank. Instead of you getting a new loan, the seller gives you a loan that wraps around their existing mortgage. You pay the seller, and the seller continues paying their original lender. Here's the critical difference. The original mortgage does have a due-on-sale clause. That means the original lender could demand full payment if they find out about the sale. While they often don't enforce it if payments are made, the risk is there. And here's the biggest risk point. If you, the buyer, default on the wrap loan, the seller is still legally responsible for their original mortgage. So, sellers, choose your buyers wisely. Buyers, make sure your seller is financially stable. So why bother with these? Assumable loans. Pros: lower interest rates, potentially easier qualification, lower closing costs. Cons: limited availability, only FHA, VA, USDA. Seller might not agree, still need lender approval. Wraparound mortgages. Pros: extreme flexibility, especially for buyers with less than perfect credit. Faster closing, seller can earn interest. Cons: higher risk for both buyer due on sale and seller buyer default. Typically higher interest rate than the original loan, more complex legal setup. The bottom line: both assumable loans and wraparound mortgages offer creative paths to homeownership, bypassing traditional bank hurdles. But they come with distinct benefits and risks. Always, and I mean always, consult with a real estate attorney and financial advisor before diving into these. Don't go it alone. That's your quick breakdown of assumable versus wraparound mortgages. Did this shed some light? Let us know in the comments below. Don't forget to like this video, subscribe to ShopRates for more real estate insights, and hit that notification bell so you don't miss our next breakdown. Thanks for watching, and we'll see you next time.